Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm here with Evan Einhorn of Modern Home Lending. Uh, he is our preferred lender for a lot of reasons we're going to talk about today, and super knowledgeable, been in the business for years. Doesn't look like it, but he's been in the business for years.
Yeah,
And how's everything going on your end right now, Evan?
everything's good.
Good.
Our industry's always changing, so we're just rolling with the punches and helping our clients and making sure they understand the market just as much as we do. So,
Absolutely. If it
yeah.
can happen, Evan will make it happen. Trust me, and you'll get the best service, best deals possible. So, with that, we had a few topics I wanted to go over with you today. A lot of things going on, a lot of things maybe people aren't aware of. So, I like to do our weekly market updates, and this will be a nice way to kind of add to that. So, thank you for being here. Um, first thing I wanted to talk about was there's this new Vantage Score program that Bill Pulte with FA Fannie and Freddie came out with. Can you tell us a little bit about what that is and what it's not? You know, there's a lot of info out there. I know maybe it was actually initiated back in 2018, but never really solidified until it sounds like they're really moving hot and heavy on it now. Is that,
Yep.
yeah.
Yep. So, I mean, when we run credit scores for clients, there's three credit scores we run, and we pick the middle. The Vantage score is going to be a nice alternative. So they've been trying to do it
To
for
FICO,
years.
right?
The FICO. Yep.
To
Yep. Yep.
FICO.
Yep. So what they basically announced, it's been in the works for a while, but basically no updates or movement. They keep pushing it back a couple years, but now it sounds like they're saying, "Hey, we're going to make this happen." So as soon as we see the logistics, as soon as they say, "Hey, here's how you can send us loans with the new score," and as soon as lenders and investors say, "Hey, here's how you can send us loans," great. We can already run the new score. We just can't close loans with it yet. So it could be a week, could be a few months, could be a year, but at some point in the near future, the good news is we'll have two options. So if someone has maybe a 690 credit score on one and a 740 on another, it just gives us two options, as
Very
far
exciting.
as where we're at. So it gives us twice a chance maybe for approval, or for a possibly better rate.
That's
So
exciting.
it's good. It's just more fair and just more options because I mean, credit scores are what they are. A lot
Yeah,
of people hate them.
sure.
um, but it's just one algorithm.
And
It'd
it
be nice
could,
to have two.
I mean, theoretically, yeah, nothing's really kind of hashed out yet, but theoretically, it may offer people not only that competition, so maybe some better scoring, maybe lower fees, possibly theoretically, right?
Yeah, like our credit reports, our full credit reports, are just over $100. Clients don't pay that until closing. Like we do soft checks first, we pay for it up front, all that kind of stuff. Hopefully, that'll come back down because in 2020, our credit reports costs were about a third of that. So it's small
Awesome.
fee, but it's definitely something that will help. Every dollar helps for sure.
And I'm going to explain to you why you definitely want to work with Evan in a little bit, besides his experience and everything. But I'm going to hold that so you keep you in suspense why you're going to save a lot of money with Evan. But uh, so right now there's so many things going on, but one of the biggest things is obviously what affordability, right? You've got some people who maybe feel sort of locked in, even though they may want to downsize or upsize because they've got affordability issue to begin with if they're a first time home buyer, or maybe they have like a 2 or 3% interest rate that they got a few years ago when the rates were super low. So, what are some solutions to that portion? I know there's assumable. There may be some other bridge loan type things that could help people out a little bit. What do you suggest on those type of things?
Yeah, I think assumables are definitely underutilized. So for people that know out there, Chris can actually send you a list of people in your area that are looking or that are selling their home and then have a loan that can be taken over. So if someone bought or refinanced in 2020, 2021, 2022, maybe they have a rate of 2.5 or 3 or 3.5. There are certain loans that you can actually take that over from the seller. Now, there's different down payment requirements, and we can help with the second mortgage if needed to help bridge the gap. But with more homes being on the market, there's more opportunity to take that over. So as long as you're willing to, have a limited number of homes that you're looking at. So instead of maybe looking at, 50 homes, you might have five. But if you can get a 2 or 3% rate, even better. And then Chris can send you that full list, which is really nice.
Yeah. Yeah, we could filter that right out of the MLS very easily
Yep.
for you and then go
Yep.
from there. Um, and tell us a little bit about your bridge product that you have. It's similar to some other ones out there that tell
Yeah.
us a little bit more about that.
So there's we always say like there's 5 different ways to buy before you sell. One is that, hey, if you have the down payment and you qualify for both homes, great. Not everyone can, but if you're lucky, great. Two, if you qualify for both homes, but you need the down payment, there's a way that we can actually pull cash out of your current house to put down on the new one. That's pretty easy. We also have one that if you have 20% down on the new one, we can just automatically ignore your current payment if you have enough equity. So you're only qualifying for the new one. But if you don't have the 20% down on the new one, maybe you have a small down payment and then you can't qualify for both. One of our partners that we work with does have an option that we can actually ignore your current mortgage. So you're only qualifying for the new one. And the fee for that is basically 1% of your current home price, minimum of 5,000. Um, which again, my wife and I recently moved in 2023. We have two small dogs. We don't want to buy and sell at the same time and have people coming through our house. So like we bought, you know, and thankfully we were able to qualify for the new one and then sold. And that was just way easier on us and our family moving and all that. So
Yeah.
it's just it is 5,000, but it's a convenience to pay to be able to buy your new one and then maybe touch up your old house, do some paint touch ups, stage it while all that get top dollar, move out, and then sell it.
It wouldn't even have to pay that till you close. In other words, that
Exactly.
1%. Now, on that score, you do have one that even allows for maybe sprucing up a current home. Is that correct?
Yeah.
With
So,
a little bit
so
higher fee. And by
there,
the way, there are other programs out there, guys, but this 1% to begin with, this 1% is actually about a percent or a percent and a half lower than a lot of programs out there that I've seen.
right,
Uh,
right.
so
So
without mentioning all the names of the different companies that do it, but so this
it's
is
very competitive.
yeah,
Yeah.
yeah.
And it's a
So
convenience fee in my opinion.
yeah,
And
so yeah, if they want to do some, let's say some freshening up on paint or minor spruce up of the house, there's another fee associated with that right before they put it on the market, correct? With that program.
if they wanted cash out to do that,
Yeah.
then yeah, there are some options where the fee is closer to 2 or 2.5%, where they're actually pulling even more cash out. But there might be some alternative ways that we just do a HELOC, a regular small HELOC instead, and then still have the 1% fee, to keep
Oh,
costs low. So there's a lot of different options. I think a lot of people are like, here's what you qualify if you sell, and here's what you qualify if you don't. And they don't look at all these other alternatives. And
yeah.
it's just, you know, um, especially if someone, maybe qualifies for both homes or has enough equity and they just need the down payment, like pulling money out of your current house doesn't have to be super expensive, for a
Yeah.
bridge loan or temporary loan. So,
Awesome. Now, looking at moving on to a first-time home buyer,
yes,
well, first of all, before we move on too far, going back to the Vantage program, that will also allow renters, again, theoretically, once it's in place, right, to utilize their rental payments as another trade line, correct? If they needed to.
that's supposedly yes,
Yeah.
but we can actually already use that right now.
Okay.
So if someone's borderline qualifying on FHA or conventional, um, and it does have to be either, there's some caveats on how it works with the system, and it will pick up from your bank statements. If your rent is basically the same or similar for 12 months, it can pick it up if it matches the application. That we can actually, the system will auto recognize that if you link your bank statements. And so if you are borderline qualifying, it'll recognize the rent as an additional credit reference, if you want to say, because it's not adding it to your credit report, but the approval system's recognizing, hey, you paid rent on time for the last 12 months. And that is weighed importantly, maybe if someone only has one credit card and maybe an old collection, from a
Gotcha.
while ago that, the system might not approve, adding rent is definitely helpful in that case. Yeah.
Gotcha.
So,
And with the Fannie model, that's just for conventional. But
mhm.
with the model that already exists, it may work for FHA or
So it definitely works for conventional FHA. It's more of a manual process where we check a box to say that, yeah, we can verify rental history.
okay.
I haven't seen it impact too much, but it is there. So if someone
There
doesn't
could
have
be
a ton
certain
of credit,
circumstances.
exactly,
Yeah.
exactly.
Yeah.
So
Okay.
yeah.
And along those lines, then with the first time home buyer, everybody always asks, what are those first time home buyer programs out there? We get that question every day. It
Mhm.
seems like, somebody's asking about that, which makes sense because they hear or see all this stuff online.
Yeah.
So, nothing new, DPA or down payment assistance programs. There's a million of them out there. But can you explain the one that you have or what you have for options there?
Yeah. So, being frank, most down payment assistance programs come with a higher rate,
Hmm.
or they come with like a long time working through like counseling through the state and all that, and like limited funds. So there have been a couple that have come and gone pretty quickly,
Hmm.
where the state just went through the funds and there was only two counseling agencies and it was a headache. And, I had clients that, could have bought five different homes in the time that it took just to get pre-approved with that program.
Yeah.
But the good news is we do have one program where for 3% down payment, they'll actually cover 2% up to 7 grand. So if you're buying a $300,000 home, there is an option that you can just put 3,000 down. You'll get another 6,000 in a true grant. And the nice thing about this is it's true market rate. So obviously rates vary by day, but you're not getting a higher interest rate with this program than you would be with a regular 3% down.
Gotcha.
So
That's nice.
yeah, that is super nice. There are income limits. So like in the Phoenix area, it's just over 87,000. It'll vary by county. But if you're a first-time home buyer making less than 87,000 and change, there's no reason not to use this because it doesn't come with a higher rate. And if
Okay.
you're thinking, we make 100,000, like it's qualifying income. So if you're 80,000 salary and 20,000 commission or overtime, or maybe one person makes 80,000 in the household and the other person makes 30, but we only need the person that makes 80,000 on the loan, that works too. So don't count yourself out on the income limit. Like reach out and we can see if you're eligible for this. If not, there are other programs that have no income limits, but the rates
Okay.
are a little higher. Still better than a lot of the state programs though.
Yeah.
So
Yeah, that makes a lot of sense, especially with
yeah.
the better rate. Yeah.
Yeah.
And the lowest possible, with no junk fees with you guys at least
Yep.
added on to whatever program it is.
Yep.
So that's
So
nice. Um, so one other aspect I wanted to talk about was VA. A lot of times, VA buyers, I feel like they get taken advantage of sometimes, or they just don't know what really to look for in, whether it be a realtor or loan officer, and they just kind of go with the big names out there. And guys, I can just say this first off: if you see a bunch of marketing online, that means that marketing that's happening is probably going to be passed on to the consumer. Okay, you've all seen the big names that are advertised out there, even at Super Bowl time. Okay, let's just put it that way. We won't mention any names, but that probably means they're most likely a retail lender. That probably means that they're passing a lot of those fees on to you. Um, if you're in the military, uh, especially, you probably have seen certain banks or companies out there that you're kind of pushed to use in a way, so to speak, just because they seem like they're military friendly. Again, I won't mention any names. But Evan, could you tell us a little bit about that? Because from what I've seen with your company, even on their best day, you guys beat them out on fees and stuff. Is that
yeah.
the case?
Yeah. And again, there are good companies out there, that are advertising. It's just a different business model.
Sure.
If you're spending millions of dollars on advertising, Um, even if you're paying your people less and the process isn't that good, like it still comes out in the rate. So even the big banks and big lenders and people that specialize in VA. Unfortunately, a lot of the people that advertise they specialize in VA, you're really just calling a call center,
Yeah.
and again, good company, good mission, good values.
Right.
It's just different business model. So as a smaller broker, we have no processing, no underwriting fees. Um, we're more competitive across the board. We're better than average on conventional FHA, VA, but unfortunately on FHA and VA, VA is for veterans, FHA is more lenient on credit, lower down payment. There's a lot of lenders that just take advantage just because the VA is the best loan out there. It's by far the
Yeah.
best loan, better than physician loans out there because it's 0% down, no mortgage insurance. That honestly, even if you increase the rate by 0.5%, which is what some of these lenders do, it's still a great loan, but
Yeah.
they know they can make more money on it, which is honestly lots of times why people focus on the VA loan. We don't do that. We treat everyone the same. And you would think it would be opposite. You'd think that a lot of our veterans would actually be getting a better deal, which they are because of the program, but unfortunately, a lot of lenders like actually make more money on VA deals, purposely because they can and they think they can get away with it. So it's a pet peeve of mine. But we treat everyone the same. We help everyone, and
Yeah.
we better rate. And then some of the big ones that are competitive, honestly, our rates are similar, but we just have less fees. So no
Yeah.
processing underwriting fees. Yeah.
Yeah. Yeah. And we just had somebody that we referred through your company, and they were getting one quote where they needed an extra 50 grand to qualify for the house they really wanted. They weren't able to get it at the other one, but with your company, they were able to get that house
Yeah.
at a reasonable, reasonable rate, reasonable fees or lower fees than what they were
Right.
being quoted. So,
Yeah.
it's a huge advantage. And tell us a little bit about, you said business model, no junk fees. You're a broker. So people understand why they would want to work with you, and why we like working with you a little bit more in
Yeah.
depth on what that means, a broker versus the retail
Yeah.
lender.
I mean, we truly do shop for your loan. So we get paid by the lenders. We don't care who we send it to. There's some lenders that are a little easier to send it to than others, but we treat you like I would treat my own loan. So we have over 30 lenders. We don't always go with the cheapest because honestly, they might not be able to close on time. But that's a conversation we'll have of, hey, of our 30 plus, who's the best price, who can get it done for your specific situation. So if it's a VA deal, we have certain lenders that are pricing well today. If you're conventional, putting a huge down payment, there's others. If you're looking to use that special down payment assistance program, there's another one. We have a loan underway right now that someone's buying an investment property. They're not working right now, so they can't qualify for a regular loan. They're using this no income investor loan, and they shot me against another loan officer, and they're like, "How are you so cheap?" And it's like, it's this one bank in Texas that's like 0.5% better than any of our lenders. So like we were beating someone else's like regular investment loan program, and this person was like, not using income to qualify. So it's just shopping around. Honestly, I'm kind of a mortgage nerd that
That's good. That's what we
I
want, right?
enjoy learning all the programs, but yeah, we have conversations with our clients, figure out what they're looking to do, review the different options, and sometimes we pre-approve people two ways and say, hey, if we're going with a fixed interest rate loan, like here's our best loan option, here's our best lender. But hey, if you're okay with an ARM, ARMs have come back a little. That we do have a few clients that have taken a 7-year ARM, which ARM is an adjustable rate mortgage where they're not quite as scary as a lot of the ones from years ago. Like a 7-year ARM means it's a fixed rate for the first 7 years.
Yeah.
So your principal and interest doesn't change for 7 years. Depending on the client, like we have seen those be, you know, for just over 0.5% cheaper, which, you know, could be $100 or $200 a month, and not too big of a risk if you think you'll either be selling or refinancing within 7 years. A lot can happen in 7 years.
Yeah. Yeah. Well, and right now, one of the hot topics is, should I rent or buy, right? Because of affordability. And I always tell people, look, if you're going to be in a place a couple of years, it might make sense to rent, right? And
Yeah.
you're going to be moving. But once you start getting into the third, fourth, even fifth year, it totally makes sense. And we know that homeowners are about 40% have about 40 times the wealth
Yep.
of a renter. I mean, that's just the statistics that's been around forever. Um, you know, and I tell people right now, you can get lower rates right now, even if it's not an arm. If you're like, oh, arm, I'm scared of an arm. Well, really about 50% of the sellers out there are buying down buyers' rates. They're also paying closing costs, title fees, whatever. Um, so that's something that we can negotiate on our end. And of course, Evan comes into play there too, with making sure that you're getting the best possible pricing.
Yep.
So
Yep. And a mortgage, I mean, I joke around, I'm really good at spending money. I think most people are.
yeah,
And I'm really good at investing money. The whole savings thing is not great. So a mortgage is it's a forced savings plan. Your
yes,
mortgage goes down every month. Over time, home values do go up and down, but over
hmm
time it does go with inflation, that,
yeah,
um, for me, it's nice just owning long-term real estate that, my first home that I bought, I kept, and by the time I retire, it's gonna be paid off, and that entire rent payment is almost gonna be like another social security check for me in my head. But there's a lot of different ways to think about it. Definitely a
sure.
good long-term game for sure.
Sure, sure.
Yeah.
And really quick on the affordability thing too. I have a lot of conversations with people on my end, and I'm not. I always tell them I'm not the loan officer here, but if you're looking at a $10,000 decrease on a negotiation, you may save right now what 80, $90 a
Not
month.
60. Yeah. Yeah,
Yeah,
yeah, roughly.
versus getting a buy down rate. Again, could be fixed, right? Could be a fixed buy down rate, and let's say 100 basis points or 1%, that could be a 250 to $300 a month savings, correct? I mean, on
Yeah, I
that
mean,
big of a swing.
rough numbers, like if
Yeah,
you get, well, there's different kinds of buy downs, but yeah, it would
right.
be over $100 on a permanent buy down if you're using that. Or you could opt to say, hey, I'll use all that money, and a 2-1 buy down where you get a 2% lower rate your first year and a 1% after. It's, on a $400,000 loan costs less than 10,000, and you're going to save over $500 a month your first year and over 250 your second year.
Yeah,
But when we talk to our clients, we look at all options. We say, okay, if you're getting
sure.
this much money from the seller, here's how we can use it. Or does it make better sense with the price reduction? Usually not, but but how can we use the seller credit, and what makes sense for you and your situation? And is there anything changing in a couple years with your financial situation? Like, we have those conversations to look at like short and long-term goals.
Yeah, and the nice thing is with those buy downs, that money's sitting in that escrow account later on. If you ever want to refi, it's not only no out of pocket, but it could be virtually zero cost
Yeah, I mean,
on a refi down the road when rates do drop.
yeah, most of our clients do opt to, one, we don't have processing and underwriting fees, but most of my clients do opt to choose an interest rate where we're covering the title fees as well. Um, but on that temporary buy down, it's even better because if you do use the money towards the temporary buy down, and we have a separate video on temporary buy downs, and reach out to us and happy to share that with you. But we can basically, if you refinance in that first 1 or 2 or 3 years, whatever the buy down length is, any money from the seller, you'll actually get refunded. So none of the money goes to waste from the seller, which is kind of nice in that situation.
Beautiful, beautiful.
Yeah.
Um, well, did you have anything else that you wanted to share, Evan, that could be helpful for people? Any programs or any other advice?
Yeah, I mean, it's also, you know, it's also custom and personal, same thing with
It
real
really
estate.
is. Yeah,
What do they say? Location, location, location.
100%. Yeah,
That there's a lot of information online lately. Like I see information about parts of Florida and like Austin, Texas, like they're getting hit hard, really hard price wise.
yeah,
Even if you look at parts of the valley, certain parts of the valley are much stronger, and some of the parts of the valley are showing some weak signs. So
right.
just reach out to us. There's not one size fits all as far as real estate goes, and same thing with loans. I
Yeah,
get calls all the time. Hey, what's your rate today? And I'm like, to be honest, thinking about it, we have people anywhere from like a 5.25 to a 7.5 today.
yeah,
you know, which 7.5, you'd be like, oh, that's high. But it's like, well, no, it's like a no income loan and they're not putting a lot down, like all this kind of stuff. And then the
right.
5.25, hey, how are you getting that? But we're getting money from the seller and paying down points. Like, so
Yeah,
everyone's situation is different for sure.
Sure, sure,
So
sure.
yeah,
Yeah, and right now, I would say again, affordability may be an issue, but we are in the valley anyway. We are more buyer market right now, according to the Cromford Market Index. So, you can just get better chance of getting better deals right now on
right.
those buy downs or price reductions and stuff. So, yeah, well, I guess we'll wrap it up there. And again, if you have any questions at all for Evan, how do they reach out to you? What's the best way for them to contact you?
Yeah, so you can go to modernhomelending.com. You can click on any of the things there, and then I'm at the top of our team page. Or you can reach out to me, Evan at modernhomelending.com, email or my phone number, 602-456-2273. You can call or text. That goes directly to me. And always happy to chat and brainstorm. So
Yeah,
what
and
about you,
Evan
Chris?
Evan is
Yeah.
the owner. Evan is the owner
Yes.
of the company. So
Yes.
yeah, he's gonna get you the best, I would say best buying value and power on whatever you're looking at that's possible. So and again for me, you can always go to mincolagroup.com and 480-788-8569 is our main line where you can call or text us, or you can always email us at home@mincolagroup.com. So with that, thank you guys, and we'll talk to you next time.
Thank you, Chris.
Thank
I
you.
appreciate it. We'll see ya.